The rise of Paul Tudor Jones, the making of a trading legend. In the vast and volatile world of finance, where markets rise and collapse like waves in a storm, few names command as much respect, or evoke as much curiosity, as Paul Tudor Jones. To some, he is the ultimate trader's trader, the man who saw the storm of 1987 before it struck. To others, he is a philosopher of risk, a man who turned chaos into opportunity and built a fortune by mastering the unpredictable rhythm of the markets. But behind the billions, behind the legend, lies a mindset, a way of thinking about money, risk, and human nature that separates ordinary investors from icons. This is the story of that mindset. Paul Tudor Jones was born in 1954 in Memphis, Tennessee, a long way from Wall Street's flashing tickers and trading floors. He was not born into extreme wealth or privilege, but he was born with something rarer, a fierce sense of competition and an almost obsessive curiosity about how the world works. His father, an editor at a business newspaper, often brought home stories about the financial world. Young Paul absorbed them like oxygen. But he wasn't just reading headlines, he was reading patterns, learning that behind every financial event was a human decision, a psychological pulse. After graduating from the University of Virginia in the mid-1970s, Jones began his career not in a sleek investment bank, but in the pits of the New York Cotton Exchange. There, surrounded by chaos, shouting, and sweat, he found his education. The trading pit was a brutal meritocracy, no titles, no excuses. Either you made money, or you didn't. Jones often said that this experience taught him the essence of markets: the market is never wrong, opinions often are. In those pits, he learned that price was truth, and emotion was the enemy of reason. But what truly set Paul Tudor Jones apart wasn't his ability to predict prices, it was his ability to survive. Many traders came to the exchange with confidence, few left with capital. Jones developed an instinct for risk long before he had systems or computers. His golden rule: protect your capital at all costs. Long before he was a billionaire, he thought like one, because billionaires think in terms of survival first, profit second. By the early 1980s, Jones had founded Tudor Investment Corporation, his own hedge fund. He was barely in his 30s, yet already he had something most traders never achieve: conviction. His style combined the ferocity of a pit trader with the analytical calm of a macro strategist. He looked not just at charts or data, but at the global chessboard: interest rates, currency trends, political shifts, human emotion. He believed that markets, at their core, were reflections of psychology. If you could understand the crowd's mind, you could see the next move before it happened. Then came 1987. The year of the crash. For most, it was chaos. For Paul Tudor Jones, it was vindication. Using a combination of historical analysis, market sentiment, and gut instinct, he predicted the crash of October 19, Black Monday, when the Dow Jones Industrial Average fell more than 20% in a single day. While billions were lost across the world, Jones's fund posted a gain of more than 60%. It wasn't luck. It was preparation meeting conviction. He had studied the patterns of past collapses and saw the same signs repeating. His message was simple but timeless: markets may change, but human behavior does not. But here's the paradox that makes Jones fascinating. Despite his fame from the crash, he never glorified it. He saw the victory as dangerous, because success breeds arrogance, and arrogance kills traders. He once said, "Don't focus on making money, focus on protecting what you have." It was the philosophy of a man who understood that risk is like gravity: it never disappears, no matter how high you climb. As his wealth grew, so did his sense of responsibility. He founded the Robin Hood Foundation in 1988, a nonprofit dedicated to fighting poverty in New York City. For Jones, wealth was never the end goal, it was a byproduct of discipline. His philanthropy reflected the same principles as his trading: invest where it matters most, manage risk, and create long-term impact. But what made Jones truly legendary wasn't just his performance, it was his mindset. He approached markets as a living organism, something dynamic, emotional, and beautifully irrational. He often compared trading to boxing. You have to be prepared to get hit. You can't avoid it. The question is, how fast do you recover? That recovery speed, emotional resilience, is what separates great traders from gamblers. And Paul Tudor Jones mastered it. His approach could be described as global macro intuition backed by rigorous discipline. He blended technical patterns with deep macro understanding, reading charts and reading people. He'd dive into the psychology behind movements, often quoting history, philosophy, or even spirituality when explaining markets. To him, charts were not lines, they were stories of fear and greed. By the 1990s, Paul Tudor Jones had become a mythic figure. His trades were studied, his interviews dissected. Yet, he remained surprisingly humble, often saying that every day in the markets felt like his first. That humility, born from respect for uncertainty, became his edge. In a world of overconfidence, he thrived on doubt. He didn't seek to be right, he sought to avoid being wrong. And perhaps that is the core of Paul Tudor Jones's genius. He knew that in markets, certainty is an illusion, and risk is the only constant. So he built his empire not on predictions, but on preparation. Not on hope, but on discipline. He once said, "The secret to being successful from a trading perspective is to have an indefatigable and undying and unquenchable thirst for information and knowledge." To him, learning never ended, because markets never stopped teaching. As part 1 closes, one truth becomes clear: Paul Tudor Jones didn't just trade markets, he mastered human nature. He turned chaos into clarity and risk into rhythm. The next parts of this story will dive deeper into how he does it, the strategies, the psychology, and the mindset that made him one of the greatest traders in history. Because for Paul Tudor Jones, trading was never just about money. It was about understanding life through the lens of risk. The psychology of risk and timing the market, Paul Tudor Jones's approach. In the high-stakes world of trading, where the difference between profit and loss can come down to a split second, the ability to read the market is as crucial as any financial model. But Paul Tudor Jones understood something that many investors miss: it's not just about reading numbers, but about reading human behavior. The heart of Jones's success lies in his understanding that markets are driven by emotions, fear, greed, optimism, and panic, and that mastering the psychology of risk can be the key to unlocking massive gains. Jones didn't just view the market as a mechanical system of inputs and outputs. He saw it as a living organism, constantly reacting to the psychological pulse of the crowd. To Jones, the price movements were not mere fluctuations but reflections of collective emotions that often led to irrational, extreme behaviors. Understanding that markets were driven by human psychology was the bedrock of his strategy. In this part, we dive into the psychological underpinnings of Jones's trading approach, exploring how he used the ebb and flow of human emotion to his advantage. His ability to time the market, recognizing when fear would drive prices lower and when greed would push them higher, has been the hallmark of his career. Risk management, according to Jones, wasn't just about numbers, it was about understanding how to react in times of market chaos and how to navigate psychological extremes to make profitable decisions. The art of anticipating human behavior. The most important tool in Paul Tudor Jones's arsenal is his ability to anticipate human behavior. He understood that prices are not just driven by supply and demand, but by the emotions and psychological biases of investors. This was something that Jones learned early in his career, particularly during his time on the New York Cotton Exchange, where he first encountered the raw emotions of traders. Jones has often spoken about how he learned to tune into market sentiment, the collective mood of the market that could drive bubbles and crashes. He had a unique ability to sense shifts in sentiment, recognizing when markets were becoming overly bullish or irrationally pessimistic. He believed that markets were inherently volatile, and that this volatility was amplified by human emotions. Fear and greed, he argued, were the driving forces behind most market movements. In many ways, Paul Tudor Jones's trading was a psychological experiment. He would place bets not just on what was happening in the market, but on what he expected the market to believe in the coming days or weeks. He would often say, "It's not what the market is doing, it's what the market thinks it's doing." In other words, perception is reality in the financial world. When the crowd starts to believe that prices will continue to rise, the market moves higher. And when the crowd turns to fear, the market falls. Jones's job was to spot these changes in perception and capitalize on them before they became widespread. The role of risk in timing the market. A defining characteristic of Jones's approach to trading is his mastery of timing, the ability to enter and exit positions at the right moment. Unlike many traders who make decisions based on fundamental analysis or technical indicators, Jones relied heavily on his understanding of psychological momentum. He recognized that market cycles were driven by the ebb and flow of human emotion, and he used this insight to time his trades with precision. Jones's ability to time the market was rooted in his recognition that markets do not move in straight lines. Instead, they experience cycles of expansion and contraction, driven by changing emotions. Whether it was the euphoric rise of a bull market or the paralyzing fear of a bear market, Jones knew how to capitalize on these emotional extremes. He would often say, "The market is a pendulum that swings between optimism and pessimism." He understood that these swings were inevitable, but it was his ability to spot them early that allowed him to capitalize on them. A crucial part of this timing was his use of technical analysis to identify turning points in market sentiment. While some investors focus solely on fundamentals or economic indicators, Jones's technical indicators were designed to identify when emotions were about to shift. For example, he was known to use chart patterns and momentum indicators to determine when the market was at an inflection point, when fear was giving way to greed, or vice versa. This focus on timing made Paul Tudor Jones an invaluable strategist during times of market turbulence. He had a remarkable ability to navigate crisis points, such as during the 1987 stock market crash, and make profits by understanding the psychology of panic and fear. Crisis periods were when Jones excelled. While others were paralyzed by the volatility and risk of the market, he understood that crisis often signaled the best opportunities. The 1987 crash was a perfect example of this. While the market was in freefall, Jones's fund posted substantial gains by betting against the panic and capitalizing on market overreaction. The fear of missing out, FOMO, and market psychology. In the world of trading, one of the most powerful psychological forces is FOMO, the fear of missing out. This is a sentiment that plagues both retail and institutional investors alike. When prices start to rise and the herd mentality sets in, FOMO can push traders to make irrational decisions, often causing them to enter the market too late or take on excessive risk. Paul Tudor Jones understood the danger of FOMO and often positioned himself opposite to the herd. In his early career, Jones noticed that most traders were fearful of missing out on a big market move, and would often pile into overbought stocks or overvalued assets. He realized that FOMO was a force that often drove bubble-like behavior, causing the market to become disconnected from underlying fundamentals. By recognizing when the market was succumbing to FOMO, Jones was able to take positions that would profit when the market corrected itself. For example, during the dot-com bubble of the late 1990s, when technology stocks were soaring, Jones remained cautious, refusing to follow the herd. While many investors were riding the wave of irrational exuberance, Jones knew that the market was being driven by FOMO and speculation. When the bubble eventually burst in 2000, those who had been swept up in the rush faced significant losses. Jones, however, had positioned himself to profit from the downturn, capitalizing on the market correction. Risk and leverage, the art of risk management. One of the most important aspects of Paul Tudor Jones's approach to trading is his use of leverage, the ability to amplify gains, and, of course, losses. Leverage is a double-edged sword. While it can increase potential returns, it can also magnify risks. Jones was known for taking large, leveraged positions in the market, particularly when he felt confident about his analysis of market sentiment. However, he always managed this risk carefully, using stop-loss orders and other risk management techniques to prevent catastrophic losses. Jones's use of leverage is rooted in his psychological approach to risk. He didn't see risk as something to fear, but as something to measure and control. He believed that taking calculated risks with a clear exit strategy was the key to achieving long-term success. This mindset allowed him to make big, high-conviction bets, yet never put his entire fortune on the line. Jones would often say, "You never go broke taking profits," highlighting his belief in managing risk by taking small, calculated losses while letting his winners run. Jones's use of leverage also tied into his overall market philosophy. He was a global macro trader, making large bets on economic trends, interest rates, and geopolitical events. When he believed in an opportunity, he didn't hesitate to amp up his position. But he also understood the importance of protecting his downside. By focusing on managing risk through disciplined trade setups and psychological awareness, Jones created a strategy that allowed him to profit from both bull and bear markets. Paul Tudor Jones's long-term philosophy: risk aversion and adaptation in a changing market. The world of trading and investing is ever-changing, with new technologies, market conditions, and geopolitical events constantly shifting the landscape. For many, the pace of change can feel like a moving target, sometimes too fast to react to or adapt. But for Paul Tudor Jones, the ability to adapt to changing circumstances, all while managing risk, has been at the core of his long-term success. While he's known for his market timing, macroeconomic analysis, and emotional intelligence, Jones also understands the value of risk aversion, being able to avoid situations where losses are inevitable. This principle of risk aversion has evolved throughout his career. Early on, Jones had the typical confidence of a young trader, eager to make high-conviction bets and trade aggressively. However, over time, he realized that protecting capital was just as important, if not more important, than making profits. The central tenet of his philosophy, "protect your downside, and the upside will take care of itself," encapsulates this more mature approach to trading. In this part, we will explore how Jones managed risk in an ever-changing market environment, how his strategies evolved over the years, and how his long-term philosophy allowed him to survive, adapt, and thrive in different market conditions. We'll also look at how risk aversion is not about avoiding risks altogether but about controlling and measuring risks to make sure they don't overpower the rewards. Adapting to change, the evolution of Jones's risk strategy. Paul Tudor Jones's early career as a trader was shaped by the relentless pursuit of profits, using the principles he learned on the New York Cotton Exchange to build his early fortune. However, it wasn't long before Jones realized that the market was not static, it was a living, breathing system, constantly evolving based on global events, changing economic policies, and psychological shifts in investor sentiment. In the early 1980s, when Jones founded Tudor Investment Corporation, the market was booming, stock markets were rallying, interest rates were high, and inflation was a significant concern. This environment demanded a specific approach to trading, macro trading, where Jones made bets on large-scale trends in currencies, commodities, and stocks. Yet, as time went on, Jones realized that markets were no longer behaving the way they had in the past. The volatility that characterized the 1970s and early 1980s began to wane as central banks and governments intervened more actively in the markets, using monetary policy and fiscal policy as tools to stabilize economies. The environment was changing, and Jones knew that in order to remain competitive, he would need to evolve his investment philosophy. One of the biggest changes Jones made was his shift from short-term speculation to long-term trend following. As markets became more stable and less volatile, Jones moved away from high-frequency trading and began to focus on longer-term macroeconomic trends. He began to follow market cycles and understand how interest rates, inflation, and geopolitical events shaped global markets. This adaptation was critical to Jones's ability to not only survive but also thrive in evolving market conditions. By shifting to a long-term mindset, Jones found that he could ride out volatility without being trapped by the whims of short-term price movements. He was, in many ways, becoming a long-term risk manager, focusing on the long horizon rather than the quick wins that come with speculative moves. The role of risk aversion in long-term success. In Paul Tudor Jones's trading philosophy, risk aversion was never about avoiding risk altogether. Instead, it was about strategically managing risk to ensure that the downside was always limited. Jones believed that if you protected your capital and took steps to ensure that your losses were minimal, the long-term profits would eventually take care of themselves. Jones's evolution into a risk-averse investor is a testament to his ability to learn from both his successes and his failures. He once said, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." This mantra reflects his belief that losses are an inevitable part of investing and trading, but catastrophic losses can be prevented with the right strategies. Jones made a name for himself by avoiding the fatal error, the one big decision that wipes out a career. Jones's psychological approach to risk aversion. Jones has always recognized that psychology plays a huge role in how investors manage risk. The human mind, with its cognitive biases and emotional responses to fear and greed, can often be the biggest risk of all. Jones, a keen student of market psychology, understood that emotions could cloud judgment and lead to poor decisions. For instance, when the market is rising and everything seems positive, investors can overestimate their ability to predict future outcomes, leading to risky decisions. On the flip side, in periods of downturns, fear and panic can cause investors to pull out prematurely, selling at the wrong time. Jones used this psychological insight to his advantage by controlling his emotions and sticking to a disciplined approach. He was known for creating a mental checklist before making major trades, ensuring that each decision was based on rational analysis and historical context, rather than gut instincts or emotional impulses. One of his most famous principles was his stop-loss strategy, which helped him cut losses before they became too damaging. This principle of cutting losses quickly and letting profits run was a key part of his risk aversion strategy. Jones's ability to maintain emotional control in the face of extreme market conditions is one of the factors that set him apart from many of his peers. During the 1987 market crash, when fear and panic ran rampant across Wall Street, Jones's calm, rational decision-making allowed him to protect his capital while profiting from the chaos. This ability to stay calm under pressure is a hallmark of his long-term strategy, and it is this kind of psychological resilience that has helped Jones survive and succeed in the constantly evolving world of finance. Jones's adaptability to changing markets. As financial markets evolved through the 1990s and 2000s, Jones continued to adapt, always staying ahead of the curve by understanding global macroeconomic shifts and anticipating market changes. For example, the introduction of electronic trading and the rise of algorithmic trading changed how markets operated. Where once the floor traders controlled the market, technology allowed for faster, more efficient trading. Jones responded by adapting his strategies to fit this new environment. Rather than becoming reliant on short-term trading, he turned to longer-term, more fundamental strategies, focusing on global trends such as interest rates, political developments, and technological innovation. He continued to hedge his positions, managing risk in a way that allowed him to maximize profits while ensuring that the downside was always protected. Through each market cycle, Jones has managed to not only survive but also grow his wealth. His ability to adapt to changing environments while maintaining his core principles of risk aversion has been a key reason for his long-term success. Paul Tudor Jones's long-term philosophy and its impact on risk management. Paul Tudor Jones's success is built on a philosophy of long-term thinking, psychological resilience, and disciplined risk management. Over the years, his ability to adapt to changing market conditions, combined with his focus on protecting capital, has allowed him to not only survive but thrive in some of the most tumultuous financial environments in history. Jones's long-term strategy is not about avoiding risk but about understanding it and managing it carefully. By making calculated decisions, understanding psychological market dynamics, and adapting his strategies to meet the challenges of the ever-changing financial world, he has become one of the most respected figures in the investment world. In the next parts of this documentary, we will dive deeper into Jones's macro strategies, the specific tools he uses to analyze markets, and how he has managed to remain one of the most successful hedge fund managers in the world over several decades. Paul Tudor Jones's macro strategy, the tools of a trading legend. In the world of trading, few investors have mastered the art of understanding global macro trends like Paul Tudor Jones. His ability to make significant, high-conviction bets on entire economies, currencies, and commodities has earned him a reputation as one of the most successful global macro traders in history. But what truly sets Jones apart from others in the trading world is not just his ability to predict market movements but the tools and frameworks he uses to analyze and execute his strategy. In this part, we explore the specific macro tools that Paul Tudor Jones employs in his investment process, shedding light on how he reads global markets, understands economic shifts, and capitalizes on the psychological undercurrents that drive price movements. Jones's approach to global macro investing is not driven by technical indicators or traditional fundamental analysis alone. Instead, he combines economic theory, historical trends, and a keen understanding of human psychology to create a holistic approach to predicting market shifts. This blend of factors has been instrumental in his legendary success, allowing him to make large, high-conviction bets on currencies, interest rates, and commodities, even when the broader market is uncertain or volatile. The macro lens, understanding global economic forces. Paul Tudor Jones's macro strategy begins with the understanding that financial markets are deeply interconnected with global economic forces. Unlike traditional stock pickers who focus on individual company fundamentals, Jones looks at the big picture. He focuses on the forces that shape the global economy, such as monetary policy, fiscal policy, political events, and geopolitical risks. His view of the market is not limited to domestic issues, rather, he consistently evaluates the interrelationship between economies, currencies, and assets on a global scale. One of the most important concepts in Jones's macro investing is the business cycle, the recurring pattern of economic expansion and contraction. He carefully monitors the key indicators that signal turning points in the economy, such as inflation, interest rates, and unemployment levels. In Jones's view, understanding the global business cycle is essential for identifying opportunities in the market. For example, when inflationary pressures rise and central banks respond by tightening monetary policy, Jones will often make strategic bets against currencies or commodities that he believes will be adversely affected by the shift. Jones also emphasizes the importance of understanding the psychological forces at play in the global economy. He frequently discusses how market sentiment, driven by fear, greed, and uncertainty, often distorts the true economic picture. While many traders may rely on economic indicators to make decisions, Jones believes that market psychology is often the most accurate predictor of market movements. He uses technical indicators and historical patterns to gauge market sentiment, allowing him to anticipate shifts in global economic conditions before they become obvious to the broader market. Risk management, the core of Jones's macro strategy. While Paul Tudor Jones is known for his bold, high-conviction trades, one of the defining features of his macro strategy is his unwavering commitment to risk management. Jones has built his wealth not just by identifying market opportunities but by protecting his capital from catastrophic losses. He has always stressed that the key to long-term success in trading is preserving your capital and avoiding big mistakes. This philosophy of risk management runs through the core of his global macro strategy. The first principle of Jones's risk management approach is the use of stop-loss orders. While stop-loss orders are a basic tool in the trading world, Jones uses them as part of a holistic risk management system. He believes that cutting losses early is critical to preserving capital and ensuring long-term success. Jones has often said that, "You're never going to make money being right on every trade, but by cutting losses quickly, you prevent a single bad trade from derailing your entire portfolio." Jones is also known for using position sizing as a tool for managing risk. In his approach, no single trade should represent a disproportionate amount of a trader's total capital. By ensuring that no single bet is too large, Jones protects his fund from exposure to major losses if a trade goes against him. Diversification, in Jones's view, isn't about spreading risk across a wide range of positions, but about ensuring that each position is small enough to withstand unexpected market movements. In addition to stop-loss orders and position sizing, Jones also uses macro hedging as part of his risk management strategy. Hedging involves taking offsetting positions to reduce the risk of significant losses. For example, if Jones has a large position in an asset that he believes will rise in value, he may hedge his exposure by taking a counterposition in a related market, such as a currency or commodity that is correlated to the asset. This strategy allows him to mitigate risk without giving up on potentially profitable opportunities. The art of timing, combining macro insights with technical tools. While Paul Tudor Jones's macro strategy relies heavily on his understanding of global economic trends, he also uses technical tools to time his trades. Jones blends fundamental analysis with technical analysis, using the latter to pinpoint the optimal entry and exit points for his trades. This fusion of macro insights and technical analysis gives Jones a unique edge in global markets. For example, Jones often uses chart patterns to identify turning points in the market. By looking for specific patterns such as head and shoulders or double tops, he can anticipate when a market may reverse its trend. Additionally, Jones frequently uses momentum indicators such as the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD, to assess whether an asset is overbought or oversold. These tools help him time his trades with greater precision, ensuring that he enters the market at the right moment to maximize his returns. One of Jones's most notable trades came during the 1987 stock market crash. As the market plunged, Jones anticipated the sell-off by observing technical patterns and economic signals. He used a combination of momentum indicators and his understanding of macroeconomic trends to position his fund to profit from the crash. Jones's ability to combine technical analysis with a macro view of the market allowed him to not only protect his capital during the downturn but to also capitalize on the volatility when others were losing their heads. The Global Macro Playbook, Currencies, Commodities, and Geopolitics. One of the key elements of Paul Tudor Jones's macro strategy is his ability to identify opportunities in currencies, commodities, and global geopolitical events. Jones has often said that a trader is only as good as the environment they're trading in, and he believes that understanding the broader global context is essential to successful macro trading. For instance, Jones has made significant bets on currencies, particularly when he believes that a country's monetary policy or economic fundamentals are about to shift. In the early 1990s, Jones famously bet against the British pound during the European exchange rate mechanism crisis, a trade that earned him billions. By understanding the interplay between interest rates, inflation, and exchange rate policy, Jones was able to anticipate the collapse of the pound and profit from it. Similarly, Jones has often made macro trades in commodities, such as oil, gold, and agricultural products, by understanding the supply and demand dynamics that drive these markets. For example, during times of geopolitical instability, Jones often buys gold as a hedge against inflation and currency devaluation. By reading the global economic landscape, Jones has positioned himself to profit from commodities during periods of economic crisis or market dislocation. Geopolitical events are another critical component of Jones's global macro strategy. Understanding how wars, trade agreements, or political instability can affect global markets allows Jones to predict major shifts in asset prices. During the 2008 financial crisis, for example, Jones was able to anticipate the economic fallout from the collapse of Lehman Brothers and position his portfolio to capitalize on the ensuing volatility. By using his macro insight into global politics, Jones was able to make significant profits during a time of extreme uncertainty. Paul Tudor Jones's macro strategy, a legacy of adaptation and discipline. Paul Tudor Jones's global macro strategy is built on a deep understanding of human behavior, market psychology, and the interconnectedness of global economies. His ability to combine economic theory, technical analysis, and psychological insight into a cohesive approach has allowed him to achieve remarkable success in some of the most volatile markets in history. In this section, we've examined the tools Jones uses in his macro strategy, from his understanding of global economic trends to his use of technical indicators and risk management techniques. By blending these elements, Jones has not only navigated market volatility but also capitalized on it, turning periods of instability into opportunities for profit. As we move into the next parts of this documentary, we will explore how Paul Tudor Jones continues to evolve as a trader, how his macro strategy has influenced the broader hedge fund industry, and the lessons that investors can learn from his remarkable career. Paul Tudor Jones's long-term outlook, philosophy, patience, and visionary thinking. In the fast-paced world of trading, where the pressure to make immediate decisions can often overshadow long-term goals, Paul Tudor Jones stands out for his unwavering commitment to long-term thinking. Although known for his ability to capitalize on short-term market movements, his success over the decades is rooted in a unique ability to think well beyond the moment. For Jones, trading is not just about reacting to market fluctuations, it's about understanding the deeper forces at play and recognizing that real wealth is built through patience, strategic positioning, and visionary thinking. In this section, we will explore how Paul Tudor Jones's long-term outlook has shaped his trading decisions, his philosophy on patience, and the ways in which he anticipates global trends. His long-term perspective has allowed him to adapt to market changes while maintaining a fundamental belief in the cyclical nature of global economies and the human psyche. Jones is a rare combination of macro trader, philosopher, and visionary, whose commitment to long-term strategies has made him a revered figure in financial circles. A vision beyond the markets, understanding the macro forces of change. Paul Tudor Jones is not a trader who reacts solely to technical charts or recent headlines. He is a visionary in the truest sense of the word, looking well beyond immediate market trends to anticipate the big picture. His approach to investing is rooted in the understanding that global macroeconomic trends and human behavior are deeply intertwined. He doesn't just see the market as a series of transactions, he sees it as a reflection of larger social, economic, and geopolitical shifts that are constantly evolving. Jones has always been interested in the big forces shaping the world: monetary policy, technology, demographics, and global trade. By recognizing and understanding these forces, he is able to predict the future direction of markets. For example, technological innovation and the global shift towards digitization have been key drivers in Jones's macroeconomic thinking. He has frequently highlighted the impact of automation, artificial intelligence, and the global flow of capital as critical factors in shaping the future of global markets. In his view, successful investors must not only track the present but also anticipate the next phase of global development. One of Jones's most notable long-term bets was on commodities and natural resources. Long before the rest of the world began to recognize the potential of these markets, Jones was already positioning his fund to profit from the rising global demand for oil, gas, and precious metals. He understood that rising global populations and increasing industrialization in developing nations would drive long-term demand for these resources. While many investors were caught up in the short-term volatility of the stock market, Jones was thinking ahead, aligning his portfolio with the inevitable growth of global infrastructure and the energy sector. Jones's long-term perspective is also reflected in his analysis of central banks' monetary policies. As quantitative easing and low interest rates began to dominate the global economic landscape following the 2008 financial crisis, Jones recognized that the consequences of these policies would be felt far beyond the short term. He predicted that central banks' intervention would lead to increased inflation, greater income inequality, and asset price bubbles. His ability to see the long-term effects of monetary policy helped him position his fund to not just survive in the aftermath of the crisis but to thrive in an era of global economic uncertainty. Patience, the key to surviving volatility and market cycles. While many traders are driven by speed, reactionary trading, and short-term profits, Paul Tudor Jones has always emphasized the value of patience. This is an aspect of his strategy that is often overlooked by newer traders who are more focused on making quick, short-term gains. Jones's belief in patience is one of the reasons he has survived decades of market cycles, from the boom of the 1980s to the crash of 2008 and beyond. Patience, in Jones's view, isn't about waiting for the right opportunity to come to you, it's about waiting for the right market conditions to materialize, ensuring that you position yourself correctly when the time comes. Jones often speaks about how patience allows him to avoid getting caught in market noise. He believes that the market's short-term movements are often influenced by emotional volatility, fear, greed, and speculation, which can cloud rational judgment. But patience allows Jones to block out the noise and focus on the underlying fundamentals that drive long-term growth. By keeping a clear, long-term perspective, he can avoid getting swept up in the market's daily fluctuations and position himself for the inevitable corrections and opportunities that arise when the market swings too far in one direction. For Jones, patience also means accepting loss as part of the process. Unlike many traders who panic when their positions go against them, Jones is able to wait for the market to realign with his original thesis. This ability to endure short-term drawdowns without succumbing to emotional panic is crucial to his long-term success. In this way, patience and discipline form the backbone of his entire investment philosophy. Adapting to market cycles, lessons from the past and vision for the future. Paul Tudor Jones has lived through a variety of market cycles, and with each cycle, his approach to trading and investing has evolved. He has seen the boom of the 1980s, the collapse of 1987, the dot-com bubble, the 2008 financial crisis, and the rise of populism and political instability in recent years. With each cycle, Jones's ability to adapt to changing market conditions has been crucial to his sustained success. What sets Jones apart from many of his peers is his flexibility. While some investors stick rigidly to one strategy or system, Jones recognizes that the market is dynamic and requires continuous adaptation. He understands that economic environments change, that technological advances disrupt old models, and that geopolitical risks shift the balance of global power. The key to Jones's success is his ability to not just identify trends but to adapt to them as they evolve. For example, Jones's approach to commodities evolved over time. In the 1980s and 1990s, he saw the potential in oil and precious metals as global growth drivers. But as the global economy began to shift, Jones shifted his focus to alternative investments and emerging markets, understanding that the demand for technology and global infrastructure would reshape the investment landscape. His willingness to evolve with the times allowed him to remain relevant as new market opportunities arose. Jones's commitment to long-term growth, impact on his legacy. Paul Tudor Jones's long-term outlook on investing has not only contributed to his personal wealth but also shaped his legacy as a trader. Tudor Investment Corporation, his hedge fund, has consistently performed well over the years, driven by Jones's discipline and vision. But beyond his financial success, Jones has made a lasting impact on the broader financial industry, particularly with his views on macro trading and risk management. Through his philanthropic work, Jones has also demonstrated that his long-term vision extends beyond personal wealth. In 1988, he founded the Robin Hood Foundation, a non-profit organization aimed at alleviating poverty in New York City. His commitment to using wealth to create social change reflects his holistic approach to life, where financial success is not an end in itself, but a means to an end. Through the Robin Hood Foundation, Jones has influenced education, public health, and economic justice, while still maintaining his dedication to building long-term wealth for his family, investors, and the world. Paul Tudor Jones, a visionary of risk, patience, and global change. Paul Tudor Jones's approach to trading and investing is far more than a series of successful trades. It's a philosophy grounded in long-term thinking, discipline, and a deep understanding of the human and economic forces that shape our world. By combining patience, risk management, and a visionary view of global markets, Jones has achieved sustained success and built a legacy that spans both the financial world and the broader world of social change. In the next sections of this documentary, we will explore how Jones's influence on macro trading has shaped the hedge fund industry and the lessons his risk-averse yet visionary approach offers to traders and investors today. His ability to adapt to changing market conditions while sticking to core principles of capital preservation and patient decision-making ensures that Jones's strategies remain relevant for future generations of investors. The legacy of Paul Tudor Jones, influencing hedge funds and modern macro trading. As one of the most influential figures in the world of finance, Paul Tudor Jones has left an indelible mark not only through his own success but also through the profound influence he has had on the broader hedge fund industry and global macro trading. His innovative trading strategies, coupled with his philosophical approach to risk management and market psychology, have set the stage for how hedge funds operate today, and his influence continues to resonate in the strategies employed by next-generation traders. In this part of the documentary, we will explore how Paul Tudor Jones's legacy has shaped the hedge fund world, how his global macro strategy has evolved into modern macro trading, and the lessons that contemporary investors can take from his methods. From his early predictions of market crashes to his innovative use of computer models, Jones has not only built a successful trading empire but has also transformed the way hedge funds approach risk, volatility, and market trends. The hedge fund revolution: how Paul Tudor Jones changed the industry. When Paul Tudor Jones founded Tudor Investment Corporation in the early 1980s, the hedge fund industry was still in its infancy. The traditional investment strategies at the time were often limited to long-only equity investing, focusing on a more passive approach. However, Jones brought a dynamic, active trading philosophy to the industry. His ability to make large, high-conviction bets on global markets set the foundation for macro hedge funds to flourish. Jones's macro-focused approach, where trades are driven by global economic trends, political shifts, and psychological market factors, was groundbreaking. He was one of the first to see the potential for macro trading as a distinct discipline within the hedge fund industry, distinct from the long-short equity strategies that were traditionally employed. Global macro trading became a cornerstone of Jones's strategy, and it has since become one of the most popular and profitable styles of hedge fund management. Before Jones, many hedge funds were focused on stock picking and specialized strategies, such as event-driven or arbitrage trading. While these approaches had their merits, Jones recognized that the broader economic picture, inflation, central bank policy, geopolitical risks, often provided far more lucrative opportunities. His ability to anticipate macroeconomic trends, such as changes in interest rates or currency values, set him apart from his peers. His vision of investing in entire markets and global economic forces was revolutionary. Jones's success sparked a wider interest in macro hedge funds. Over time, many other hedge fund managers adopted similar macro strategies, using the same global insights and market timing techniques to make profitable trades. For instance, George Soros and Stanley Druckenmiller, both of whom were contemporaries of Jones, also used similar approaches, further cementing the global macro style as an influential pillar of hedge fund strategies. Global macro trading today: Paul Tudor Jones's enduring influence. Today, global macro trading remains one of the most respected and profitable approaches within the hedge fund world. But while many hedge fund managers now employ Jones's core principles, they have also evolved and refined his techniques in ways that reflect the technological advancements and changes in the global financial landscape. One of the most important ways Paul Tudor Jones's legacy has shaped modern macro trading is through the integration of advanced technology and computer modeling. While Jones relied on intuition and historical analysis, modern macro traders have incorporated quantitative models, machine learning algorithms, and artificial intelligence to predict market movements and optimize trading decisions. For example, Jones was one of the early adopters of computer-based trading systems in the 1990s, utilizing quantitative data to improve decision-making. Today's hedge funds, particularly those focused on systematic global macro strategies, have taken this further, building sophisticated AI-driven models that analyze vast amounts of market data in real time. However, despite the advancements in technology, the human element in global macro trading, something that Jones perfected, remains central to success. Jones's ability to read market psychology and predict emotional shifts in market participants is an element that no computer algorithm can fully replicate. In a world where data analytics and algorithms drive much of the market's behavior, the human touch, understanding emotion, human behavior, and psychology, continues to be a valuable edge for macro traders. Modern traders may have more advanced tools at their disposal, but the fundamental principles of macro trading, driven by global economic trends, technological shifts, and psychological analysis, remain as relevant today as they were during Jones's heyday. Jones himself has often stated that, even in the face of rapid technological change, the core of trading remains unchanged: understanding the dynamics of markets, human psychology, and the broader macroeconomic forces at play. Risk management in hedge funds, continuing the legacy of Jones's principles. One of the most enduring aspects of Paul Tudor Jones's legacy is his approach to risk management, which has had a profound impact on the entire hedge fund industry. Jones's mantra, "Protect your downside, and the upside will take care of itself," has become a guiding principle for traders and fund managers across the world. His emphasis on protecting capital was revolutionary for hedge funds in the 1980s, and it remains one of the key differentiators of the successful hedge funds of today. Risk management has always been at the heart of the hedge fund business, and Jones's focus on minimizing large losses while capturing profits from macroeconomic trends has proven to be a durable and profitable strategy. Jones's use of stop-loss orders, position sizing, and strategic hedging helped him to limit exposure and avoid catastrophic losses. These techniques have now become standard practice in the hedge fund industry, as funds focus on preserving capital while generating returns. Moreover, Jones's emphasis on psychological discipline, remaining calm in the face of market volatility and understanding the forces that drive market cycles, continues to influence modern hedge fund managers. Emotional resilience remains a critical aspect of successful trading, and Jones's ability to stay composed during market turmoil has been studied by many. Hedge fund managers today continue to incorporate Jones's psychological insights into their risk management strategies, learning how to navigate market uncertainty without letting emotions drive their decisions. The cultural shift in hedge funds, influence on hedge fund managers. Paul Tudor Jones's influence extends beyond just his trading strategies, it has shaped the very culture of hedge funds. As one of the first hedge fund managers to place such a strong emphasis on risk management and global macro trading, Jones helped create a new mindset in the industry. Today, hedge fund managers operate with a much greater understanding of the interconnectedness of global economies, the importance of market psychology, and the need to remain disciplined in the face of market volatility. Jones's creation of the Robin Hood Foundation also demonstrates how hedge fund culture has evolved to embrace social responsibility alongside financial success. While the hedge fund industry was once seen as a world of high-stakes profits at any cost, Jones's emphasis on philanthropy has encouraged a more balanced approach to wealth creation. His commitment to using his wealth for social change has inspired other hedge fund managers to integrate social responsibility into their investment strategies, promoting a culture of giving back within the hedge fund world. The idea that wealth can be used not only for personal gain but also for the public good has become an increasingly important cultural shift in the hedge fund world. Today, many hedge fund managers are involved in socially responsible investing, SRI, and impact investing, using their profits to support causes such as education, healthcare, and environmental sustainability, in a way that reflects Jones's personal philosophy. The enduring influence of Paul Tudor Jones on modern hedge funds. Paul Tudor Jones's legacy in the hedge fund industry is undeniable. His innovative trading strategies, emphasis on risk management, and ability to anticipate global trends set the standard for modern macro traders and hedge fund managers alike. His impact extends far beyond the specific trades he made. Jones transformed the way hedge funds think about risk, global markets, and psychological factors. Today, his influence can be seen in the strategies of global macro hedge funds, the way risk is managed, and the cultural shift toward social responsibility in the finance world. Jones's ability to remain disciplined in the face of volatility, combined with his holistic understanding of markets, makes him a figure whose legacy continues to resonate. In the final part of this documentary, we will explore Paul Tudor Jones's enduring philosophy, his vision for the future of investing and the lessons modern investors can learn from his exceptional career. Adaptability, risk management, and visionary thinking will continue to guide new generations of traders seeking to emulate Jones's success. The philosophy for the future, Paul Tudor Jones's legacy and the next generation of traders. Paul Tudor Jones is not just a titan of finance, he is a philosopher, a visionary, and an educator. His impact on the world of trading and investing extends far beyond his career achievements. His trading philosophy has shaped an entire generation of traders, and his long-term vision for the markets continues to influence hedge funds, macro traders, and investors around the world. In this final part, we explore Paul Tudor Jones's legacy, the philosophies he's passed on to the next generation, and how his methods continue to resonate in today's rapidly changing financial landscape. While Jones's success has been built on a foundational understanding of global macro trends, human psychology, and risk management, it's his ability to adapt to market changes that has ensured his place as one of the most respected figures in modern finance. Jones has never rested on past accomplishments or clung to outdated strategies. Instead, he has continually refined his approach, remaining relevant in a world where technology and market dynamics are shifting faster than ever before. His legacy, therefore, is not just about financial acumen but about visionary adaptability, ethical responsibility, and a deep respect for the cyclical nature of global markets. Adapting to change, Jones's vision for future market cycles. One of Paul Tudor Jones's most compelling traits is his ability to anticipate change. Throughout his career, he has consistently positioned himself to take advantage of shifting market trends, whether that was the commodities boom in the 1980s or the rise of digital economies in the 2000s. Jones's ability to adapt his strategies to new market realities has been a cornerstone of his success, and it is a crucial part of his legacy. But perhaps more than anything, it is his view of future market cycles, and the lessons those cycles impart, that will define his enduring influence. In his more recent years, Jones has turned his attention toward the intersection of technology and finance. He has consistently expressed the belief that the next big market revolution will come from the integration of artificial intelligence, blockchain, and digital currencies into the global financial system. Recognizing that the future of finance will be intertwined with these technological advances, Jones has encouraged traders to embrace change and remain agile in the face of new challenges. He has stated that artificial intelligence and machine learning will revolutionize financial markets, pushing investors to evolve their strategies and integrate new tools into their analysis. This is a theme Jones has explored extensively in recent years, acknowledging that the tools of the past, while critical, will not be enough to navigate the complexities of tomorrow's financial world. He advocates for learning new technologies, staying ahead of the curve, and balancing the old with the new. But Jones is also aware of the dangers of excessive technological reliance. In his view, no matter how sophisticated our tools become, they cannot replicate the human element in investing, the emotional intelligence, the understanding of market sentiment, and the ability to make long-term decisions with conviction. It's this balance between technology and human intuition that forms the backbone of Jones's philosophy for the future. Philosophy of patience and discipline for the next generation. In the fast-paced, high-stakes world of modern trading, where success is often measured by short-term performance, Jones's message to the next generation is clear: patience and discipline are still the most critical components of long-term success. While the world of finance has changed dramatically since Jones first began trading in the 1980s, the core principles of risk management, patience, and strategic thinking have remained timeless. For Jones, trading is about survival before profit. The next generation of traders must understand that success doesn't come from predicting every market move or chasing every trend, it comes from being able to adapt to the market cycle while managing risk and capital preservation. Jones has often emphasized that emotional control is as important as technical skills in trading. Reacting impulsively, he warns, is the fast track to failure. In his many public interviews and speeches, Jones has consistently shared a message of mental resilience. The modern trader must be able to weather the storms of volatility without being swayed by short-term market fluctuations. The key to this mental fortitude lies in discipline, a quality Jones has cultivated throughout his career. His focus on risk management and capital protection is an essential piece of his advice for the next generation. Whether you are managing a small portfolio or running a massive hedge fund, preserving capital and staying disciplined is the only way to ensure long-term survival in the market. Jones's long-term discipline and emotional resilience have set a standard for future investors. He teaches that when things go wrong, and they inevitably will, bouncing back quickly and learning from mistakes is more important than trying to avoid mistakes altogether. This growth mindset is critical in a world that can often feel chaotic and unpredictable. Ethical responsibility and social impact, Jones's philosophy of giving back. Another pillar of Paul Tudor Jones's legacy is his commitment to social responsibility. Throughout his career, Jones has repeatedly emphasized the importance of using financial success as a means to bring about positive social change. In 1988, he founded the Robin Hood Foundation, a non-profit organization dedicated to alleviating poverty in New York City. The foundation has raised billions of dollars and funded hundreds of programs aimed at fighting poverty, increasing access to education, and improving healthcare. Jones's philanthropic efforts reflect his belief that wealth should not only be accumulated but used responsibly to make a lasting impact on the world. As he has often said, the way you make money in the market should be aligned with what's good for the world. He advocates for a world where financial success is not just a symbol of personal achievement, but also a platform to create real change in society. For the next generation of investors, Jones has stressed the importance of considering the ethical implications of their financial decisions. The future of finance, in his view, should not just be about maximizing returns but about aligning capital with values. As the world faces unprecedented challenges, climate change, economic inequality, and political instability, Jones believes that future traders and investors must take a holistic approach to finance, one that balances the pursuit of wealth with a commitment to social good. The enduring influence of Paul Tudor Jones, Lessons for Modern Traders. As we look to the future of global finance, it is clear that Paul Tudor Jones's influence will remain profound. His long-term thinking, adaptability, and commitment to risk management have set a standard for how traders should operate in an ever-evolving world. His legacy is not just in the billions he has earned but in the philosophy he has imparted to future generations of traders, a philosophy that focuses on patience, discipline, and social responsibility. For the modern trader, the lessons from Jones are clear. The future is uncertain, but by understanding the global forces that shape economies, managing risk effectively, and staying disciplined, the next generation of traders can achieve long-term success. By embracing the values that Jones championed, ethical responsibility, human psychology, and macro understanding, investors can not only navigate the challenges of tomorrow's markets but also create a positive impact on the world around them. As Paul Tudor Jones's legacy continues to shape the future of trading and investing, his philosophy remains a guiding light. The next generation of traders must look not only to profit from markets but to shape markets, ensuring that financial success is not only measured in dollars but also in the positive change it can bring to society. Paul Tudor Jones's visionary legacy. Paul Tudor Jones's career has left a lasting impact on the world of investing, trading, and finance. His risk management techniques, macro strategy, and philosophical approach to trading have made him a legendary figure in the industry. His commitment to long-term growth, mental resilience, and social responsibility continues to influence investors worldwide. As the world faces new challenges, the next generation of traders must take inspiration from Jones's legacy, adapting to the future, embracing technological change, and remaining grounded in ethics, discipline, and a visionary outlook. For Jones, success is not just about profits, it's about creating a legacy that can make a lasting difference, both in the markets and in the world at large. Thank you for joining us on this in-depth exploration of Paul Tudor Jones's legacy, his macro strategies, and the timeless principles that have guided his success. Through his visionary thinking, disciplined risk management, and commitment to social responsibility, Jones has not only shaped the hedge fund industry but has also left an enduring mark on the world of finance. If you found this series insightful, don't forget to subscribe to our channel for more detailed stories about legendary investors, their philosophies, and the strategies that continue to shape the future of trading and investing. Stay tuned for more content that can help you navigate the complexities of the financial world and develop your own approach to success. Subscribe now and hit the bell icon so you never miss a video. Thank you for watching.